using specialist skills or expertise to try and understand or try and find value in the market. This is essentially the active investor.
Money, mindset.
The enterprising horse, the active investor. So you can either, this is the midfielder of your team and the dark horse. So you can either exchange your time, your sweat equity and your research or to work out essentially how you can beat the market, how you can do your own research and using specialist skills or expertise to try and understand or try and find value in the market. This is essentially the active investor. Or you can pay someone to do this, and pay an active manager to manage your part of your portfolio. So I have this as the central midfielder, as it could be part of your core of your team as part of the Football Formation Asset Allocation. So essentially it's using specialised knowledge or innovation or using your knowledge, expertise and to try and beat the market or get a better return than the market could deliver. So it's a creative, dynamic player. And there's a number of different ways you can do this. So there are a number of different investors that have been successful in the past. We're going to go through this now, and it really just you can pick different styles depending on your personality. So different personality types are better at different investing. So let's go through these. So we've got the fundamental investor, we've got the technical analysis investor, we've got the kind of specialist subject investor, we've got the contrarian investor, we've got the castles in the air investor, and then we've got arbitrage, which we'll explain these each in turn. So first of all, the fundamental analysis. This is a bottom-up approach. Essentially, this is looking at the earnings and the price of the share or price of the company and seeing is it undervalued compared to what the market is currently pricing this company at. So it's looking at the intrinsic value of this business. So even the assets, the how it's generating profits, and even things like the brand, these are kind of intangible. So sometimes how do you measure what a brand is? How do you measure kind of the brand value of Coca-Cola, for instance? So this is kind of fundamental. So this is the kind of the grandfather of this type of investor is Benjamin Graham, and he wrote a book called Intelligent Investor. So read that if you want to understand more about value investing. So yeah, price to earnings is kind of so how much is the price of what the company in the market is priced at compared to earnings, is how much profits and earnings that company is making. So yeah, sometimes it's looking at underappreciated companies. So Warren Buffett is kind of very good at doing this. So he picks up companies that the market doesn't really appreciate. So he famously bought up a small postal company near his hometown because that company had a monopoly on that business. So another company couldn't take that market away from it. So he always talks about having a moat around businesses, and this is kind of the fundamental value investor. That's the first style. So technical analysis is another style. So that's looking at charts. So looking at kind of lines on the screen and seeing essentially where the price is, trying to predict where the price is going to go to. So you look at different things like momentum, you look at trends, so looking at trend lines, and things like moving averages. And we talk about more this is much more kind of advanced subject, and we talk about this in other videos, but that's another kind of style of investing where you're trying to beat the market essentially. Another type is looking at the specialist investor. So Peter Lynch is the expert on this, or another type is Jim Slater, and he talks about the arbitrage of ignorance, essentially knowing more about a company or a sector than the market appreciates. So Peter Lynch talks about that surfers, poets or garage workers have an edge over the market. So knowing more about becoming such an expert in your field or in a business that you know more about that than the market appreciates. So then you can see if that market if that market or that business is undervalued or overvalued. If it's overvalued, you obviously don't buy that, or you would sell that. If it's undervalued, then you can buy it at a bargain. And there's a number of ways of doing this. So you might look at your industry. You work in a job and you know that industry more than a city analyst would know those companies. You might have a hobby. You might be really into board games, for instance, and so you can appreciate that a company or a board game coming out that the company owns is going to be massive. It's going to be really big. So you could buy that company on the cheap. That essentially someone working in the city, an analyst looking at just the spreadsheet, she wouldn't appreciate that price. So yeah, that's essentially you're trying to get an edge over the market. Another one would be if you go on a holiday. So say if you go to South Africa every year, or Vietnam for instance, and you've seen that a massive growth or a massive kind of spike in industry, and things are looking really good, and you think that it's much cheaper than the market's appreciating. This is how you get an edge, and this is what active investors are looking at. So horses can jump and they can gallop, but they also can be quite expensive. So when I say they can jump, so prices can jump up. So having companies in active investing, they can jump quite quickly, or they can gallop, they can run quite quickly. But then they can be expensive. Think of a horse eating the grass, or keeping a horse can be quite expensive. And yes, but essentially you could get a bargain, and the horse could gallop, and you could get you could essentially have this in your team as part of the overall portfolio. So castles in the air. So this is taking advantage of human behaviour. So Isaac Newton was kind of a classic for this, where he said that he can understand the bodies of matter, but he can't predict the craze of people. I'm paraphrasing here, but essentially he bought into the South Sea bubble really cheap, but then he got caught out and kind of lost a lot of money. So it's like looking at Bitcoin, for instance, and seeing that there's going to be growth there, and trying to catch these trends, or shorting the market, making money on the way down. Essentially, this is looking at human behaviour, seeing where people are getting caught up in trends, where people are going along with a fad or getting caught up in the bubble, and kind of thinking, trying to understand this and kind of understand this is in the price. That's the other one, Contrarian Investor. This is going against the grain, going against the rest of the market. So this George Soros was kind of famous for this. He shorted the pound there was I think like Black Monday in the 1990s, or he bought gold as well, and essentially seeing that something's massively overpriced, or something's not right in the market, and then essentially going against a lot of what the market thinks. A lot of these city analysts basically are in their own little kind of bubble. They're in their own little city of London or Wall Street. They read the same papers, go to the same networking events, they can read the same journals, or they can get caught up in their own little bubble. And if you're outside of that, you can almost say, actually, something's not right here, something's not priced right, and going against the crowd can actually pay off. So that's another one. And finally, arbitrage. So arbitrage is essentially price differences around commodities. So this might be, so I traded gas, for instance. So this would be, I made money out of arbitraging the market every day. Essentially, you're looking at different areas of prices and seeing is there the same product being priced differently. So for instance, if I traded gas, so natural gas, like when you turn on your central heating. So if it was, say, cold in the UK, for instance, more people are going to turn on their central heating, so there's going to be more demand and the price is going to go up. If it's warm, or a warmer, milder day in Germany, for instance, less people are going to be turning on their heating. There's going to be less demand, so prices will be low. So what you can do, you can buy in the low priced area, so Germany, and then you can move that in pipelines, for instance, and then sell it in the higher priced area. So that's arbitrage. Essentially, it's a difference in price, and you can do this quite often. You can do this and make money from it. It's quite you have to do it either in big volumes or do it little and often. So it's quite hard to make kind of big gains in it. But this is kind of what an active investor is looking at. It's looking at difference in prices compared to value. So this is the horse, this is the enterprising company. It's not right for everyone. It takes work. It's not, nothing's for free. So you can either pay an active investor to do that, an active manager, a fund manager to do that, where you're paying a percentage of your portfolio to an active investor, a manager, and they'll manage it on your behalf. Or you can do this yourself. It takes time, it takes energy, it takes knowledge as well, it takes intelligence and it takes guts and courage to go against what the market is thinking. And yeah, you might not get it right all the time. But yeah, so just to summarise, yeah, the active investor, we're going through technicals, technical analysis, which is like charts, lines on a screen, fundamentals, which is the underlying intrinsic value of a company, and compare that to the actual price in the market. The specialist subjects, this is having an arbitrage on ignorance. This is knowing more about a business or a sector than the market appreciates. And contrarian is going against the grain, seeing there's a big difference in prices and essentially going against the majority, going against the crowd. And then castle in the air, this is spotting growth or greed. This is essentially looking for bubbles and going against what people are thinking. This is looking at human behaviour and seeing something isn't right here, and essentially trying to make money or looking for new technologies, new kind of industries that are going to grow and making money from that. So yeah, enterprising investing, part of it is the midfielder of your team. This is the horse.
Money, mindset.